Thank you, Mr. Chairman, and I'd like to follow up on the Chairman's question with you, Ms. Yellen, with regard to quantitative easing. And you've indicated that you feel that as long as the economy remains, well, I don't want to put words in your mouth, but as the economy remains fragile, that we need to continue the accommodation from the Federal Reserve. According to the July quarterly survey of the primary dealers by the New York Fed, the Fed's balance sheet will reach almost 24% of GDP in the first quarter of 2014. And I'm concerned about the size of the Fed's balance sheet and its impact on the economy and the unintended consequences of these accommodations. It seems to me that there's a disconnect between what the Fed intended to accomplish and the results. A PIMCO executive recently stated that the $4 trillion in quantitative easing may have contributed as little as 0.25% to GDP growth. And even the Fed's own economists estimate that the QE2 added only about 0.13% to real GDP growth in 2010, and another expert has indicated that Fed policies contribute to bubble-like markets. How do you respond to the concerns that quantitative easing has limited impact on economic growth and is in fact creating very serious risks in our financial markets?
So a number of different studies have been done attempting to assess what the contribution of our asset purchases have been. And of course, this is something we can only estimate and can't know with certainty. But my personal assessment would be, based on all of that work, that these purchases have made a meaningful contribution to economic growth and to improving the outlook. Certainly, long-term interest rates, the purpose of these purchases was to push down longer-term interest rates. We have seen interest rates fall very substantially. Lower interest rates, lower mortgage rates particularly, I think, have been instrumental in, it's not the only factor, but it has been a positive factor in generating the recovery of the housing sector. House prices, after having fallen very substantially, are moving up, and I think that's helping substantially many households, including the large fraction of American households who found themselves underwater on their mortgages. It's improving their household finances. I think we've seen a very meaningful recovery in automobile sales, spurred in part, again, other factors play a role, but also by low interest rates.
But how long can we artificially hold or operate monetary policy in such, what I consider to be such extreme levels of the quantitative easing?
So, Senator, when we initiated this program, the unemployment rate was 8.1%, and the committee was somewhat pessimistic about its expectations for what we would see in the labor market over the ensuing year. In fact, the committee expected little or no meaningful progress in bringing down unemployment. And when we began this program, we indicated that our goal was to see a substantial improvement in the outlook for the labor market. So the progress of this program, it's not on a set course, it is data dependent, but we have seen improvement in the labor market.
But can it just continue indefinitely? I mean, if the labor market doesn't improve to the point that you reach your target, how long can this continue? Do you agree that there has to be some point at which we return to normal monetary policy?
So I would agree that this program cannot continue forever, that there are costs and risks associated with the program. We're monitoring those very carefully. You noted potential risks to financial stability, and those are risks that we take very seriously. The committee is focused on a variety of risks and recognizes that the longer this program continues, the more we will need to worry about those risks. So I do not see the program as continuing indefinitely.
Do you have any estimate right now as to when there may be a beginning of the tapering?
Well, we, at each meeting, are attempting to assess whether or not we have seen meaningful progress in the labor market. And what the committee is looking for is signs that we will have growth that's strong enough to promote continued progress. As the FOMC indicated in its most recent statement, we do see strength in the private sector of the economy, and we are expecting continued progress going forward. So while there's no set time that we will decide to reduce the pace of our purchases, at each meeting we are attempting to assess whether or not the outlook is meeting the criterion that we've set out to begin to reduce the pace of purchases.
My time's expired. Thank you.